Good morning, everyone. It's great to see you all here, and lovely to see some familiar faces. And welcome to this Protiviti quarterly economic update. And thank you all for those of you who have added your worries so far to our John Ashcroft wall of worry. We hope you found it very therapeutic this morning. My name is Paul Middleton, and I'm joined here today by my colleagues from Protiviti and our sister company, Robert Half. As I say, it's great to see you all here again. Today we are talking, as the title suggests, about the future of the economy, and doesn't it feel a very apt time to do that? We thought we'd found our way out of the woods, but as you were just saying, what isn't there to worry about at the minute? We thought economic confidence was rising, but last week, bang, a new variant. Borders are shutting, financial markets are wobbling, masks are returning, and confidence taking a hit. So are we heading back to the woods, or is this just a stumble in our path back to normality, whatever that normality is going to be? So to lead the debate today and to answer all those questions as normal, and more importantly, your questions, I'm delighted to welcome back Dr. John Ashcroft. As some of you may remember from his appearances in our collaboration forum and earlier economic forums, John specialises in economics, strategy, financial markets, and works with professional firms, large corporates and SMEs. He's the author of the Saturday Economist, his weekly blog published on the website of the same name that some of you may subscribe to, discussing the UK and the world economy. And if you look in the chat, there'll be a link to that there now. John specialises in viral modelling, and it's this combination of modelling and statistical fueled economics that's resonated with so many of you before. So we thought we'd bring you an update on his insights, perspective, worries, challenges, and hopefully, as normal, his optimism. So before I hand over to John, I just wanted to reflect on your feedback so far. I don't know how many of you have managed to fill in the wall of worry, but if you just show the results so far, Becky, this will, if you just share your screen, that will just arm John to make sure his analysis takes your concerns head on. Okay, I thought everyone would be saying pandemic, but interesting to see that supply chain, recruitment, interest rates are getting hits. So I know that some of you have only just joined, but if you look in the chat, you'll see the survey that will take you to this. So please click on it. It will take you 30 seconds and you can tell us what's on your wall of worry. But clearly everyone's very optimistic about growth, not worried about energy costs, as I just get my email from Bulb telling me they're in administration, and digital disruption isn't a concern at all. So good to see. But yeah, supply chain, John, would seem where to focus some of the discussion. So we'll keep that open right up until the end. So please keep entering your thoughts. Equally, if your thoughts change, please go in there and go back and update what you're thinking. Next week, Protiviti, we will be publishing our 2021-2022 top risk survey based on feedback from our global clients and business leaders on the risks that they think are most critical to their businesses that they need to recognise and address. That's our top risk survey. We do it on an annual basis, and we will send everyone here a link to it. So it'll be interesting to see how much of a correlation there is between your thinking here in that survey and what John says and that top risk survey. But back to today. John will be presenting his thoughts using some slides as normal. So if you have any questions, please ask those questions in the chat, in the Teams bar. You just click on the right-hand corner and click on the little speech icon up there, or save them up and put your hand up in Teams or physically at the end, and I'll come to you then. John will speak for around 40 minutes, plenty of time for questions at the end. But as ever, my plea is that whatever you do, please get involved. Let us know your thoughts, as you getting involved is infectious, and ultimately this is all of your forum. So John, great to see you again. Thank you for joining us, and over to you.
Okay, Paul, thank you, Paul, and good morning to everybody. It's good to have the chance to present today. So I do a lot on economics and strategy and financial markets, and I'm going to pull up my slide deck. This is a moment of truth. Let's see if we get this together. Here we go. Yes. Okay, so So this is the slide deck for today's presentation. The challenge is to check out and foresee the risk that we don't yet. It reminds me of Donald Rumsfeld, this sort of there are known knowns, there are unknown knowns and unknown unknowns. So we're not going to touch many of the unknown unknowns, but we will be looking at the economy, financial markets, and also new today, we'll be talking about forward guidance. I do the Saturday Economist, do a Monday morning market review on financial markets, and today we're previewing the first ever reveal of what we call the Friday forward guidance, where we look at interest rate possibilities across the US, Europe, and the UK. So what we've seen is the recovery UK growth has been faster than expected, not just in the UK, but across the world, and especially in the USA. There are worries about signs of overheating in the economy in the US, and to a lesser extent in the UK and in Europe. Certainly the Fed's getting very worried about overheating now and inflation. So we're talking about four topics: the world economy, quick look at the world economy, prospects of the UK, what's happening to prices and inflation, and also what's happening to interest rates. Mervyn King was challenging the current central bank crop as being acting more like King Canute and assuming their role as proper bankers. And Andrew Bailey, governor of the Bank of England, was saying that forward guidance, his own words, this forward guidance is murky, especially given the words the Bank of England use. So we're going to try and look through some of the scenarios. And I think the important thing is, in business at the moment now, it's pretty important to have your scenario evaluations. To a lesser extent for growth, we're pretty sure about growth, notwithstanding the latest COVID episode with Omicron, but it is important to have a scenario outlook for inflation and also interest rates. So trying to understand what's been going on, then we have what we call this economic shock, the economic shock of COVID. And that created, as we were talking about last time, this seismic event, the sort of seismic event with tectonic shifts in these two plates of supply and demand. So demand has bounced back severely, and the supply chains have been inhibited for whatever reason. So they're struggling to catch up, especially in shipping, but also in chips, computer chips, silicon chips, but also in other supply side materials. So this seismic shift, as the economy bounced back from the shock of last year, has created this tectonic shift in the place of demand and supply. And in the US, it's been compounded by a dose of helicopter money. Okay, you're quite right. Those who said last time, QE or asset purchase programs from the Fed and central bankers, that's not necessarily helicopter money. But the US have had their dose of helicopter money as well, when checks signed by the former president, Donald Trump, he even wanted to put his picture on it, let alone his signature, but the checks went out to households in the US, and also checks went out from Joe Biden. Something like 4 billion or trillion went into the economy, pushing consumer demand on top of the stimulus from QE. And this created, on top of the tsunami, this seismic event, this tsunami of dollars that this money's been flashing into the US economy, which is why we think inflation's been particularly exacerbated. Having said that, there was a shock of the numbers from the EU last week, but nevertheless, this is what compounding the problem of excessive demand in the US. In addition, from a labour recruitment point of view, there's been a reassessment of work-life balance, especially amongst the Generation Z. And we've talked a lot about Generation Z and done some work on Generation Z with our Dimensions of Strategy work. So if you don't subscribe to the Study Economist yet, then do that, because you get with it notes on GZ, but you also get notes on the Monday morning markets, those of you worried about financial markets, and we also do our notes on now coming soon, the financial Friday forward guidance. Now, this all leads to our wall of worry. We try and list everything anybody could ever be worried about. So we talk about the pandemic, growth, inflation, interest rates, recruitment, retention, sourcing, supply chain, energy costs, shipping costs, global conflict, watch out for Taiwan and Ukraine, global tensions in Eastern Europe and in Southeast Asia and the South China Sea, extreme weather events, ESG perspective, Zers, Generation Zers, digital disruption, digital accommodation, and the metaverse. If you're not up to speed with your digital online presence at the moment, well, get ready, because the metaverse is coming as well. Probably missing out there cybersecurity, but there's quite a lot that everybody should be worrying about all the time. And this is why it's important to have this scenario evaluation. So going back to the economies have been growing at an eye-popping rate. And when we look at the latest IMF World Growth Forecast, though, for October, they're projecting a recovery in growth this year of around 6% for the global economy after a 3% setback last year, and there'll be about 5% growth next year. So really we're steady state in the advanced economies and also in the emerging markets economies. And I think when we look at growth projection for the US, we'll touch on this in a moment in greater detail, but in the EU, on track for growth of 5% this year and maybe 4.5% next year. But generally, the world looks set for steady state growth, barring a black swan and barring exacerbation of Omicron. Now, in addition, we know that world trade has been bouncing back, a staggering recovery in world trade. And I think you had a situation last year where container capacity was being cut. In Q2, it was being cut by 10%, which has led to the additional problems this year. But when we look at the trend lines, sorry, loads of graphs in here. Those of you who love graphs, that's good. If you don't, well, bear with me. But world trade is up by 22% in the second quarter, and it's up by 15% probably in the year as a whole. And this enormous surge in world trade has caught container traffic on the hop. We've seen already problems with containers piling up at Felixstowe and vessels diverted from the UK back to Rotterdam for smaller scale assembly. And we've seen these incredible problems in the US. It's not just in the UK, but in the US, they have problems. Not only are they struggling to get the containers or the ships into the containers into the docks, they can't get the containers out of the docks. So something like, they're struggling for HGV drivers, they're struggling with chassis capacity, they're struggling for container capacity. There's something like 60 or 70 ships at anchor off the west coast of America at the moment, tying up containers and deliveries. This is compounding the supply side problems which everybody is beginning to experience at the moment. And this is a great chart, forgive me, this is a great chart from Bridgewater Associates. And here it looks at what's been happening with the trend in the blue line of the demand, the nominal demand recovery in the US for consumer goods, and the trend rate of supply, that's the red line, the lower line, which is showing the global real production of goods for US consumers. Now, you don't have to be a mathematical genius or a PhD economist to realize these lines are out of kilter. And there's another analysis from McKinsey, which shows it in even more sharp detail. So the chart on the left shows the surge in retail sales, excluding dining places in the US. So it's like shooting way above trend. There's been an element of, this strong bounce back in the economy, this tsunami of dollars surging into the economy, pushing consumer spending even higher. And this has meant that, and there's been an element of hoarding and double bubble for, certainly for some retail suppliers where they've been stocking up. This is compounding the demand side problem. So from a supply side point of view, not only is demand surging, but container capacity has been shrinking because the containers getting blocked either in the docks or on the ships or struggling. Even they're empty, they can't get them back into circulation. And this chart shows the relative supply of containers. So there's a big cut in capacity through 2019. Then there's surged in demand surge in capacity in 2019 and 2020, especially in 2020 Q2. And then this sort of collapse in availability of containers, which is all compounding the supply side. And when we look at the dwell times for, it's taking another 30 days to get the containers across the sea, but they're being hung up by initial 5 days at the moment. So 30% of the container capacity is sticking around for 5 days or more. Then there's the element of pricing. And what we've seen is that, the shipping a container from China, East Asia to the Northwest coast of America hit $20,000 in September. And now we see it's coming off the top to about $14,500 at the moment. So the good news is that some of these supply side issues that will fade. The bad news is some reckon it'll take to Q3 next year before we see a real alleviation of a reassignment of container capacity, maybe by Q2, and maybe sort of chip shortages relieved by Q3 or possibly Q4 next year. So what we see is, going back to economics for a moment, that this deficit with China, this so-called deficit with China that US was trying to eliminate with the tariffs, that's just not happening. And so now we're going to look at the specific economies of China and the US before looking at detail at the UK. So in China, they're still on track for growth of 8% this morning. Now, there's a whole big wave of anti-China sentiment coming forward at the moment. And the economy is, yes, once again on the brink of disaster. The head of MI6 was saying that China are using LinkedIn. Believe it or not, their spy chiefs are using LinkedIn to gain data on key workers in the UK, heaven forbid. And as we know, Ian Duncan Smith was railing against the risks of TikTok as being a security risk for the economy. A lot of this is clearly overdone, but it's winding up tensions, especially in Taiwan, as we saw from the Japanese Prime Minister this week or yesterday. So anyway, it's on track for growth of 8% this year. It is what we talk about, the return of the Middle Kingdom, where 35% of economic activity is this key Asia Pacific region, which is really going to be dominated by China, especially when Trump pulled out a lot of US influence in that zone. And it will overtake the US economy, we think, by 2028, and it's on track to double in size by 2035. Already, as we've said before, the largest economy, second largest economy in the world, still struggles to get in the top 50 in terms of GDP capacity. So lots of potential to grow. And we see that the yen, or the renminbi, will become at some stage the new reserve currency. Currency transactions currently dominated by the dollar, the euro, and the sterling to a lesser extent. Now in the US, we've seen that now the adults were back in the White House, we said, but currently they're squabbling about their current roles. But even so, they'll get clean growth around 6% this year, slowing to 4.5% next year, and the unemployment rate is on track to ease back towards 4.5% as we move towards through 2022. The inflation rate peaking now at about 6%. We say peaking, we hope it's peaking. Fed Chair Jay Powell was saying he doesn't think it's quite as transitory as it was previously, but we'll have to see about that. But when we look at the internal problems, what we call the twin deficit dilemma in an economy, the internal deficit is still very severe, where the government is spending a lot of money, and the external deficit, the trade deficit, is still very acute as well. And this is, from the spending point of view, the US national debt's about 28.9, several trillion or whatever it is there. So we see short-term strength for the dollar, maybe medium-term strength for the dollar, but in the medium to longer term, the fundamentals will kick in to undermine the position there. And we'll talk about our forward guidance. The Fed's dotty about the dot plot. They reckon rates will rise by about to 25 basis points by the end of next year. We now think this is out of date, which I'll touch on later. And the prospects for tapering, this is tapering, but nevertheless, tapering, they're starting to reduce their asset purchase program, and that will be eliminated at the moment by the end of September in 2022, but Jay Powell's now hinting it could end even sooner. So that's our look at the world economy. Bounce back in the UK, in the world economy, bounce back in world trade, creating incredible supply side problems as the US is scooping up a lot of product from around the world. And we're now going to look at what's happening in the UK, and a lot of charts here, but bear with me as I skip through them. So this is our current forecast for December. Actually, it's not changed much from last time we were presenting. We see growth of about 7.5% this year. It's almost mathematically impossible now not to get growth of between 7 to 8%, given the strength of the performance year to date. And we think we'll see 5.5% growth next year before reverting to trend. And our scenarios is it could even be higher this year at about 8%. It could be around 7%, which is where the consensus is presently. But nevertheless, it looks good for this year and into next year. And when we look at what is happening, we model a trend rate of growth of around 2%. And what we see is the setback in the economy last year means gradually we're going to work our way back to trend. Economists always like this reversion to the mean or reversion to normal. And that's what we're seeing in the numbers that we're presenting. And it's the same for what we call GDP output figures, a similar position where the economy will recover towards trend. We'll look at the details there. And when modeling inflation or the central bank reaction, it's important to measure the output gap. Where would the economy have been, or how far is the economy off that trend rate of growth? When we look at inflation, generally inflation this year is going to average out at 3.8% for the year as a whole, and in 3% into next year, maybe a bit too optimistic on the next year's trend. But when we look at the figures by quarter, then it's going to peak at between 4.5% Q4 this year and Q1 next year, and it could be as high as 5%. This is our scenario, okay? It's very difficult to give a specific hardline forecast, but nevertheless, we think that inflation will peak around 5% and will return to about 3 to 3.5% by the end of next year, still way above the central bank target. And when we look at interest rate expectations, the UK, bankers get very excited about this. I don't really, but generally consumers think that inflation is going to be heading to 4% plus in the years ahead. A lot of worries about unemployment earlier in the year as the furlough scheme was going to come to an end. But generally now, we'll touch in greater detail, we think unemployment could well peak just around 5% or maybe below. And when we look at the quarterly figures, it could peak up from 4.3% in the latest data to around 4.9%. And even then, it'll be sort of a cyclical, frictional unemployment as there's a reassignment of jobs. Incredible strength in the economy. We've seen vacancies surge to 1.2 million in the latest data. These are the average by quarter. And work from the IFS suggests that will return back towards 750 by the end of next year, 750,000. But nevertheless, this sort of incredible surge in vacancies to 1.2 million. And again, look at average earnings. Average earnings have been peaking at 8.8%. A lot of forecasts and negative forecasts on high earnings levels. But when we look at this graph, this shows the trend rate of earnings around 3.5%. And what you get is on all these figures at the moment, this real dislocation between things as they were and as they are now. So we see that reverting to about 3.5% as we move into 2022, because it's really a sort of readjustment from the highs, notwithstanding the increase in minimum wage and some of the wage disparate recruitment difficulties at the moment. On the labour market charts, as we say, we've got 1.2 million vacancies. These are the sectors, very similar position in the US with dominance in health and social, retail, accommodation and food and professional services. And when we look at the furlough scheme, we see how that drifted down to end up about 1.1 million at the end of September. And it's what happens to that 1.1 million that is going to be interesting. And when we look at the furloughs by sector, this is data for August, and then compare it with the furlough and vacancies, you can see a very high correlation between the figures overall, except in health and social. So basically, there is incredible numbers of vacancies in health and social care, which will pull on the economy moving forward. Whereas there's lots of expectation we could see a reshuffling of numbers between vacancies and furlough and unemployment as we move through this adjustment cycle in Q4 and into Q1. Unemployment, government like to say unemployments have picked up. Yes, they have, but they're still a bit way off where we were pre-pandemic. And some of this is foreign nationals leaving the UK, and some of it, some generational stuff where a lot of people are just quitting the workforce. In the US, the quit numbers have been extremely high. So when we look at the borrowing figures for government, then Rishi Sunak, the latest data, because it moves around a bit, is about 320 billion for last year. And we think this year it's going to be at 175 billion. And moving forward, then it moves forward into steady state. So we're less worried now. The markets are less worried about borrowing and less worried about the issues on public sector debt. If you heard me talk before, we talked about this issue of the central bank mopping up some of the government debt and the money for nothing, guilt for free program, as we call it. So we don't get overly concerned about the central bank or the Bank of England owns about a third of the debt now. So the liability of Treasury is an asset owned by the Bank of England, and both are owned by government. So one day into the future, a bit of slick intergroup consolidation, and a third of the debt could disappear. Nobody talks about that yet. Bit of detail on universal credit and furlough and the unemployment in millions. That's a summary chart. But I want to just touch on the UK trading goods, because the deficits are back on goods. Unfortunately, the trade in surplus services surplus helps to offset that. But we think we're on track for a deficit of 20 billion on goods and services into next year, which is a modest 1% of GDP or less, and not of concern to markets or bankers or government. Quick look at the difference between EU trade and the EU trading goods. Well, sadly, we're not seeing this. What's happening with newly global Britain is it's just opening up opportunities. So the big shift is there's been a little shift in export balance between EU and non-EU, but there's been a catch-up for non-EU. So there's sort of some acceleration of non-EU imports into the UK. So I'm not a great fan of truly global Britain. It's just opening us up to more competition or more imports from the rest of the world. Quick look at these forecasts. This means that real growth for the UK over the next a couple of years is going to be 15%, add in a bit of inflation, and you look at nominal growth of between 20 and 25% for the next 3 or 4 years. This is a huge opportunity to really expand and grow, and the debts will shrink in terms of debt to turnover rates for a lot of businesses. Service sector, we see strong growth there. Manufacturing, worried about manufacturing. This squiddly bit to the right-hand side means that, you know, there's been a setback in manufacturing because of supply side shortages. We've seen shocking figures coming out of the car industry because of the chip shortages, but supply side disruptions are causing us to be concerned about the recovery in manufacturing. And I think that generally what we find in every cycle, you know, going back to 1948, every time there's a setback in the economy, the manufacturing sector gets hit. And if you're lucky, it takes 10 to 15 years to get back to where we were. I speak as a student of the manufacturing sector over all of these years, having been in that place. So yeah, we're worried about manufacturing and construction to a lesser extent because there have been some supply side difficulties. So that's our overall forecast outlook. And when we look at inflation, we say, is it transitory or is it a tipping point? Well, we know prices are hotting up. This is a detailed chart from our monthly inflation outlook analysis, but we can see CPI inflation at 4.2% in October. It's generally reckoned it's going to move even higher in November. We've seen the figures from the EU this week at 4.9% CPIH inflation in November, 5% near inflation in the US, and the UK is probably going to catch up. But on the top right, you see we always analyze in between service sector inflation at 3.2% and goods inflation at 4.9%. And when we look at what's happening, a lot of pressures on input prices and output prices. Well, we're going to talk about oil next, but input prices have hit 13%. But if you see in the chart, input prices are incredibly volatile. And at the moment, when we model our inflation numbers and when we model output prices, the anomaly here is output prices, because we normally expect a pass-through ratio of around, we get this right, around 50% or 60% from input to output prices. And at the moment, it looks like output prices are increasing ahead of the cost curve overall. But we'll see how that unfolds in the months ahead. But oil is very interesting because, you know, we saw oil trading at 85, talks of it going to $100. And then there's been a real pushback this week or last week when Biden, the US government, released some of the reserves, and there was a shock to demand. So that we've seen a big fall back in oil prices. And what has been the surprising thing for lovers of techie geeky things, this is the correlation between oil prices in the blue line and the US rig count, US oil rig count. And what we see is a very strong correlation between, you know, as prices rise, the oil rigs come on stream in the US, and as prices fall, the oil rigs are shut down in the US. But since 2020, that's not been happening. In other words, prices have been rising, but the US has failed to meet the challenge. So currently it's around 467, I think, the oil rig count last week. And we'd expect it to be almost twice that at the moment. And, you know, there's pressure on ESG or and oil. Biden saying, well, you know, forget saving the world economy or the world at the moment. We need that oil production to come into place. And if you bear with me, there's another geeky chart here, but this looks at oil prices in terms of the relative change. And this is why those, you know, we're more positive about inflation being a transitory phenomena, because a lot of the price pressures in the UK are oil determinant. But when in Q2 last year, the average oil price dropped to $29. In fact, at one stage it was negative. They were paying people to roll the barrels away in the US. So what you got as prices rallied into 2021 is this, say, in Q2, oil at $70 was playing $29 last year. So the inflationary impact was highly incredible. So look at the average prices in the blue line at the top, a blue chart at the top, and then beneath that is the year-on-year inflationary impact. So this big inflationary impact from Q2, which takes maybe a quarter, 2 quarters to impact the rest of the economy, is unwinding severely. And we expect that to want to be one of the great deflationary episodes of 2022. And it's the same with, you know, at the moment, worries about lumber prices in the US. They're down by 50% or 60%, Whereas about iron ore prices, they're down by 50% from the top. And it's the same with copper, down by 20%, aluminium down by 10%. But some of the battery elements like nickel and so on, they're still relatively high. So we expect this sort of oil prices, energy prices to ease. And we also expect some of the commodity prices, especially the hard metals, to ease into 2022. Big question about gas prices and Nord Stream, especially the future for Nord Stream. At the moment, big issues relating to Ukraine and German acceptance of Nord Stream, whatever. So interesting dilemma there for the EU. So we say inflation is always and everywhere a transitory phenomena, but sometimes, as we see with the Bloomberg Commodity Index, it sometimes takes a bit longer. So finally, I'm going to look at just a bit about the Study Economist Friday forward guidance. Where next for base rates in the UK, US, and Europe? This is our 3-year quarterly forecast. Take this with a pinch of salt, because it's very much work in progress, and also trying to forecast what the central banks are going to do around the world is going to be rather challenging. But nevertheless, here goes. So this is the implied forward guidance that we give now for UK base rates, that we see maybe no hike in December. There's been no hike from the UK central bank in December before Christmas for 50 years or more. And we don't think, despite the markets suggesting maybe, we don't expect any hike this year, especially now with Omicron and with Christmas. But it's reasonable to expect a first hike in the first quarter, or late into the first quarter next year before Easter, rising towards 75 basis points by the end of next year, and then moving up to about 1.75 by the end of 24. And this is, the position that we would take as being the base case for the moment. In Europe, Christine Lagarde is saying there'll be no increase in EU rates through 2022 at all. And maybe then we would say, well, an increase of 25 basis points and then 50 basis points by the end of 23, rising by another 25 basis points. In the US, tapering, we think now has a 50% or 60% chance tapering will end in June. And now markets are pricing in 50 basis points by the end of next year, rising to 175. But when you put those, and that's a summary position in that chart. But when you put these three together, this doesn't work, right? Because it's not feasible that US rates or UK rates would rise ahead of the US. So, but it's possible that US rates may rise faster. There's also the possibility that once the Fed and put up rates by 50 basis points, they really start to worry about growth and panic and start to pause, or maybe, as we've seen before, they reverse. It's escape from planet ZERP, as we call it, the world of zero interest rates. We try to get off and get lift off before, but really struggle. So at the moment, the estimations would be we'll see US rates up to and UK rates up to 50 or 75 basis points by the end of next year, rising to 175 by 2024. And this should be a reasonable scenario model for any business at the present time. We also therefore expect that the EU wouldn't be able to lag because it would put too much pressure on the euro, and they would be likely to follow suit. So this should be a basic scenario model. You can take, if you like, the European model with no increase next year at all, or you take the UK model we put in there at around 50 to 75 basis points for next year. This is I'm going to talk about that. This is our implied forward guidance from where rates should be. Is the UK behind the curve? Yes, because according to our modified Taylor rule, which looks at inflation above target and the output gap, rates should be about 190 or 175 now. So that's why the banks are behind the curve. And these are the guys who are involved as the Bank of England hawks and doves. And there's still a chance that Rishi Sunak may have to dip into his £1 trillion. He may still be short of money. So we expect the Bank of England may ditch the 20 billion of corporate bonds it has. Why it bought them, we never know. Why it's held on to them, we never know. We can't be sure that Apple and IBM need the cash. But the Treasury may need to lean on the bank as the buyer of last resort for gilts. Finally, a quick look at our Monday morning markets. We review this every week, but we reckon the market's about 7.5% overvalued at the moment, especially in the US, where something like 15% overvaluation. Europe, not so bad, and Asia, not so bad. But, the markets, a lot of the fund managers, they think the market's overbought and they're looking for a setback. And so, when trying to understand market movements and watching the press, we quote Nietzsche in our work and say, any explanation is better than none. The markets are trying to get a setback. They didn't get it with Omicron. They're trying a bit now with taper. But if there is a setback, it just creates a great buying opportunity. And the implications for gilts, just 2 talks ago now, but the implications for gilts are that, 10-year gilts at 84 basis points in the UK is absurd. And if they were priced back, the inherent capital loss for bonds is incredibly high. On sterling, we've seen big weakness in sterling, dropping to 133. It looks a bit oversold at the moment, but generally look for fair value around 135, so not much movement there. So going back to it, that was our wall of worry. We covered a lot of the issues. I'm not sure we've solved all of them or any of them or maybe some of them, but that's the wrap up of some of the issues that we've been thinking about. So
John,
there you go.
John, thank you very much. I wasn't expecting the music there, I have to say. That was good.
No,
look, that's fantastic. You covered a huge amount there. I hope you all kept up, everyone. We'll give you all a test at the end. Please put your questions in the chat, just based on what you've heard from John there. John, you've, as ever, have shown optimism, growth, decreasing unemployment, return to trend. Who do you think are currently the winners and losers? And how is this going to change as we gradually return to trend?
Well, I think that's an interesting question. In terms of the winners and losers, we've seen a recovery across the board, really, and we're seeing moment hang-ups in manufacturing and construction. But generally, notwithstanding the setback that we have with Omicron at the moment, that the consumer is going to benefit, households are going to benefit. It just looks like a real good, strong basis to move forward at the present time. So I think that it's a good time to plan, and a lot of worries about this issues of debt and repayment of some of the debts. But yeah, it's such a great platform to move forward. It's a question of seeing through some of the headline issues, as always, to understand the more fundamentals.
Okay, thank you. You're still showing your desktop, by the way.
I know I'm trying to get out of that. Just bear with me for a minute.
That's all right. Top right-hand corner, you can just.
Okay, that's all right. I've got it. It's all right. I lost my. Sorry about that.
That's okay.
There's that.
So supply chain, we saw at the beginning in the survey we did, and as I say, that survey's still open. So please get your votes in on that wall of worry. When we looked at it initially, we saw that supply chain was the worry most on people's mind. Would you agree with that?
I think it's a bit of a concern in manufacturing and construction as being critical, especially manufacturing with so many shortages. And I think then that runs on to some of the issues relating to consumer products and consumer durables. But we've got to sort of see through some of the headlines that there's a panic about HGV drivers. There's a panic about petrol at the pumps. There's a panic about turkeys. Will there be enough turkeys? So you got to look through some of the data. But when you look at those disparities for between demand and supply in the US, and understanding the container issues at the moment, then yeah, supply is an issue because the world is going to take some time to get back to normal. And at the moment, there are problems with COVID, with shutdowns in China, problems in COVID, with problems in Vietnam, and so on. So yeah, supply side is a big challenge, and I think that but logistics guys, good logistics guys, that's what they're trying to do, and I think it's going to persist into next year. But then comes the glut. It's a big like the pig cycle, a 3-year cycle, that the glut of semiconductors is going to flood onto the market maybe by the end of next year, and then we'll see this oversupply as the demand or supply is readjusting to the current level of demand, which will be proved to be excessive. So, you listen to Cathy Woods at ARK Invest, they envisage big deflationary pressures into the economy next year, which may mean that central bank inflationary outlook and exchange rate outlook looks too aggressive.
Thank you, John. I think the second biggest one we had out there as well was then retention and recruitment. Layla, would you agree with that? Do you want to share some perspectives on that and see what John thinks?
Yeah, sure. So I think we've seen a second extraordinary year in recruitment. Last year things went very quiet, as reflected in across a number of John's graphs, with a sharp dip, and then a rise again towards the end of the year in Q4. That rise has continued into this year, and as John said earlier, well, ONS is actually 1.7 million vacancies, but if we're going to round up, it probably feels like 2 million vacancies to many people. So so we've seen what's happened this year, particularly in Q3 and continuing to Q4, is the highest number of job vacancies on record, coupled with the lowest ever number of respondents to those vacancies in job applications, and that data is taken from the job board. So I think that's been well publicised. Of course, this is leading to some challenges, across a number of sectors, and within those sectors, particular roles, the highest is tech. So any IT, front, middle, back support, software developers, full stack developers, software engineers. These roles remain a challenge for all businesses of all sizes in all sectors. Of course, that's led to a huge increase in some salaries, and naturally attrition levels remain high. In fact, according to the ONS, the biggest number of attrition, 75% of attrition, was actually related to job swapping and job hopping, probably from a reprioritization of people's priorities in life and boredom, which has led to a change in job, and of course taking advantage of rising salaries. So my question to you, John, is how sustainable is this? It seems as though this is going to set to continue into next year, but how sustainable do you think this is in terms of number of, in terms of attrition and salary increase for companies and employers?
Well, I think you've got to, we always assume it's going to revert back to normal at some stage, really. I think that given as the economy, as people accept the economy facing into next year, and we've seen the furlough scheme unwind, and we see real attitudes on working from home, then there's just so many variables in that space at the moment where businesses are trying to get to grip with their working from home model, their recruitment model, their onboarding model. And this is compounding the issues of retention, I think. So it's a difficult environment to work in and run an extended business team around the world. But it's just impractical at the moment to consider that you're going to see a lot of the sort of job swapping or job jumping and quitting that we've seen in the US, where some extraordinary numbers there. So what one's got to assume is going to settle down as we get into steady state next year. And the critical thing at the moment is absorbing the furlough numbers. So 1.1 million on furlough at the end of September. We've yet to see how that's going to unwind, given the recruitment difficulties that exist across those different sectors. So yeah, you've got to assume it's going to settle down at some stage, but
yeah, absolutely. Thanks, John. I think we're certainly in agreement.
You just gone on mute there, Layla. Please.
Because you said you were in agreement. That's what she couldn't bring herself to say live.
That's right. No, please. Please. Again, just don't be shy. Put your comments in the chat. Tell us if you agree or disagree with Layla, John, on that. Energy, John. There's a question in the chat around what impacts do you think we might feel on the inflation rate and the economy more directly from the dislocation we've seen in the energy market and the subsequent oligopoly being formed by the big six firms?
Well, energy, we look at the oil situation is pretty clear as input costs on energy. So first of all, at one level, we've not really seen a coherent grand plan from government about energy supply. And I think that, working at Chamber of Commerce a couple of years ago, businesses weren't so much worried about pricing, they were worried about availability and capacity. So I think that there's still questions about capacity moving forward. On specific pricing, that oil is going to unwind, and we see that inflationary impact quite clearly from the analysis. So no concerns there. Slightly more concerning about gas prices, given that the Russians, they don't need to invade during the daytime. They just switch off the gas and go in where all the lights are out. So I think there's implications for gas prices in Europe because of the dependency on the US, on the Russian supply situation there. But nevertheless, we've seen them come off the top by about 30% since the September, maybe August, September. So I think you've got to see some movement back to normality. OPEC, for example, they worry about demand disruption. So there's got an element of prices falling back. EIA models $72 through next year as the price forecast for oil. That's West Texas, but equally, gas prices are going to fall back. So I think the fundamentals suggest that prices are going to ease back into next year. Well, as for the monopoly situation, well, I'd settle for Big Six has been a good competitive issue. When they were trying to increase the number of suppliers into the market, really, as with banking, that means that the big guys got big for a reason, and we've seen one of it was the ability to forward buy and hedge. So I wouldn't worry about the Big Six, and I think the price trends mean there's adequate government regulation anyway to step in, but the fundamentals on oil and gas prices mean that, and the capacity from alternative energy and nuclear investment, then the price pattern should stabilize quite quickly, I would think.
You haven't mentioned the B word at all. Not that I heard. Brexit during the last 40 minutes. What do you? And I know that was mentioned in the chat as well earlier. What do you see as the impact that Brexit's had and will continue to have?
Oh, my word. I don't mention it because it's so heartbreaking, really. I think that you see that it's, I just don't get it. I don't understand why it happened. And I think that, we always divided the box into these 4 boxes of, 4 big reasons why: political, social, business, and economics. And we would say, political, it's about who governs Britain. That was a good question before Brexit. It's a pretty good question now. Political, who governs Britain. Social, it was all about immigration. Yeah, we need more of it. Not coming over in dinghies, but we need more of it. There's EU workers. Business and economics, we always said, forget it. There's no fundamental argument for leaving the EU. And there wasn't then, there isn't now, and everything is just compounding on the problem. So I think that, yeah, we know that truly global Britain means opening your doors to more imports from the rest of the world. And unfortunately, that means that that's not going to work out from a trade point of view.
Okay. I'm going to ask one more question before I come to the floor and make people feel awkward and ask them what their questions are. So be ready for that. John, are we anywhere near the growing forces of ESG and the themes from COP26 having an impact on oil production, trending oil prices, and the economy more generally, do you think?
Yeah, I think that it's argued that's one of the reasons why the US capacity didn't come on stream as quickly as we would have liked. There were some disruptions from the odd tornado here and there, but generally there's pressure on the oil companies not to invest in increased capacity and to disinvest. And that's why Biden was calling for almost a moratorium on some of those pressures relating to increasing capacity. So he's asked for more output from his producers in the US. But yeah, ESG is a big investment phenomenon at the moment. I mean, the governance issue has always been there and should have been there, and I think that's okay. The social issues, good pressure there. So I think the new phenomena is COP26 and the pressure on E. But I think that the big thing is getting to grips with co-production in India and China, realistically, and we can all half fill our kettles. And from the water authorities, we had a water assessment of our efficiencies. We were pretty efficient, and we also got an egg timer to plug into the shower to make sure we don't spend more than 4 minutes in the shower. So I think we can all do a little bit. I'm generally in for 2 minutes anyway. But yeah, I think we've seen some of that. It's a pressure in the boardroom and a lot of time and effort being put in place to get it right. G was always there. S should always be there. And E, everybody now has got to do what they can. So yeah, it's a phenomenon, and it's exacerbated some of the pricing issues through 2020 2021 and into 2022.
Okay, thank you for that. So, as I threatened to do, I'm opening this up. Who, any questions for John from the floor? Stick your hand up or come off mute. Gosh, you're quite a lot. Okay, I'll keep going then. John,
I have a question, Paul.
Okay.
I have a question. I was just looking at our poll results from the beginning. Some of you, thank you for those who participated. The top two wall of worry points that came out were supply chain and recruitment and retention, followed by the pandemic. But I think the pandemic over time will ease. I am interested to hear from anyone what their reasons are for voting and what the reasons are behind this. Recruitment retention, yes, that's a little bit more transparent, but certainly any specific issues from anyone around supply chain that anyone would like to share or discuss or ask John about. I'm particularly intrigued about that from any of our attendees.
Maybe let's show the results. Becky, if you wouldn't mind just showing the screen and we'll just see. So this is where you've all voted. And that's a reasonably similar trend to how we started off, with supply chain being the major worry, recruitment after that. So yeah, as Layla says, I mean, John, you've spoken to that. Do you within that see that, you know, the major dislocations being in supply chain being around, you know, where the ships are stuck, or do you see that more on the high streets? You know, where do you, if you were reflecting on that wall of worry, what do you think the main trends are around that supply chain concern?
Supply chain is very much the container issue that we've talked about in some detail, and specifically with chips, you know, chips with everything. So big issues there relating to chips, and then some of the sort of COVID disruptions in Southeast Asia from a manufacturing point of view. So yeah, the supply chain is critical. But we've covered that in a lot of detail. That's got to unwind into as supply catches up and the containers get back in place and more capacity is brought back on stream.
So when you see the, you know, where the concern that people pinpoint here, what do you think some of the lasting damage might be to our economy if these concerns play out?
I think generally after a setback, then the economists tend to worry too much about scarring. But I think overall the economy is pretty resilient in the service sector and in the construction sector, not so much in manufacturing. There's a risk we always lose capacity in manufacturing. And I think that there it'll be the same, you know, that there will be a risk that we do lose some additional capacity in the manufacturing sector, but it just takes a bit longer to get back to where it was really. The big excitement about what's happening is you know, the growth of the trend towards electric vehicles, and in the US they're getting very excited about autonomous vehicles. Not too sure about that myself yet, but you know, electric vehicles is really exciting, and the potential for infrastructure layout with charging capacities increased across the motorways of the UK means there's big investment potential there. So I think that's really something to look forward to, as well as the usual stuff on, you know, AI and robotic process automation, that sort of thing. But generally, yeah, maybe some scarring in manufacturing, but generally I think that there'll be a good recovery and good infrastructure investment. We want to see more on infrastructure with HS2 and HS3. That's not happening. We'll see what happens with the levelling up agenda. But you know, yeah, I think there's a lot of exciting investment opportunities for the UK specifically.
So you're seeing us get back to trend and almost continue business as normal. But question from John in the chat: do you see the supply chain shock that you've described intensify the rising de-Chinification, I'm not sure that's a word, but I'll use it anyway, trend in the medium term?
Decoupling, we call it. No, I think that you're going to see some elements of Samsung investments into the US on chips, but I don't see that as being a big option for the UK because we just don't have the economies of scale. So I think there's a lot of worries about taper tantering and just-in-time jitters, I would say, but really, it doesn't really work. I think we'll get back to assume normality as soon as possible. You may get JIT adjustments on stock levels, so it's not just in time, it's just in time with a bit longer, just in case, as they call it. So I don't see any sort of real dislocation and reinvestment and onshoring much in the UK at all, really. Maybe a little bit in Europe, in the US, but even then, the economists are calling for a reduction in costs, which means you don't bring it back onshore. That's even assuming you can find the workers and the skills anyway, which will be a big challenge.
And it's good to see, I think, in the or always refreshing to see, I think, in the analysis that Becky was showing earlier, where people have voted, that pandemic isn't top of people's worry at the minute. But it has obviously affected different people in society in different ways. Do you think we will see, as we come out of the pandemic and the changes that you've described, John, do you see from a social justice perspective, do you think certain groups will become more marginalized post-pandemic?
Well, I go back to, we talk about leveling up, but the reality is that child poverty is 4% in Richmond and 40% in Rochdale. And so that was the same before the pandemic, and it's the same now after the pandemic, and it's just getting worse, really. So I think that, the same social imbalances stand, and the same challenges are there. They'll always be there. So I don't think the pandemic just compounded the basic issues and the fundamental issues. But, child poverty, 4% in Richmond, 40% in Rochdale. Come on, that's like, get that leveled up if you can.
Yeah, absolutely. Well, look, John, thank you ever so much. We're coming up to the top of the hour. Thank you very, very much. Again, that's an amazing statistic-fueled session you've given us there. If you've liked what you've heard, everyone, please feel free to contact us and discuss more. Everyone here at Petivity and Robert Half will be delighted to discuss with you some more. As I mentioned at the top of the call, at the top of the forum, we will be publishing next week our top risk survey, our Petivity top risk survey. We'll send you all a link to that, and it'll be interesting to see how the risks we've discussed today and you've highlighted today, particularly around those top risks, correlate with that survey. But John, once again, thank you ever so much. Our challenge as ever to all of you is to put some of what you've heard today into action and address those risks. There'll be a video of our forum today on our website, so please feel free to share that with your colleagues, your friends, your LinkedIn contacts. So until next time, everyone, on behalf of my Petivity and Robert Half team here, I'd like to extend you all our best wishes. Stay safe, be bold, be kind to each other, and we look forward to seeing you all soon. Thanks very much, everyone. Bye-bye.
Bye-bye.
Thank you. Thank you. Thanks, John.